But let's get straight to the market action with Bespoke Investment Group co-founder Paul Hickey and Unlimited CEO Bob Elliott. Bob, you're sitting here with me on set. I'm going to kick this conversation off with you after another day higher for all the major averages. The Russell 2000 playing a mighty game of catch-up. We're up 11%. More than 11% month today, and we get a record high. What does that tell us?
Well, I think it's another indication of the over-easy monetary policy and fiscal policy that's sort of juicing the markets. And in particular, what's happening is all those areas of the market that have been left behind up until the last month, it's catch-up time. And so hedge fund managers are trying to catch up with, close short positions in the catch-up names. They're getting caught on the wrong side of that trade, and it's helping fuel that to drive higher, fuel things like the Russell 2K to drive higher.
The Russell, the Dow, we talk about this rotation, this broadening out of the rally. Paul, I want to get your thoughts on what we're seeing here, especially on a day where you had the bond market, you had Treasury yields move lower, but you also had that yield curve reinvert as well as investors digest Besant for Treasury pick.
Yeah, so I think today is just another example of, anything that could have gone wrong in the market over the last few months seems to be going right. And so Bob was just talking about the easier monetary policy. That helps things go right that could go wrong. But, you have the economy, which less than 3 months ago, we were worried about the economy falling off a cliff, so much so that the Fed had to cut rates 50 basis points. Now we're talking about the Fed dialing back the pace of rate cuts, and the U.S. economy is the envy of the world. So things have really changed as far as the economy, the election, and even earnings season that just came by was very good. So everything that could have gone right has gone right. And now, investors are feeling very confident. So now what you have to talk about here is let's not get too excited. We want markets climb a wall of worry. So let's think of things that we should be worried about here and just to keep us on our toes. And one of the things is, despite the Russell 2000 doing very well and hitting a new high today, breadth in the S&P 500, the cumulative AD line, hasn't hit a new high yet with the S&P 500. It's close, so it's not a major divergence, but it's something to be aware of. And then the semis have just been a complete disaster. We've always looked at them as a leading indicator of the broader economy in the market. And the relative strength of the semis is at a 6-month low, while the S&P is at a 52-week high or right near it. And you have, over the last 25 years, to find those types of scenarios, you go back to 2007, 2015, and 2018.
Right.
And all four of those periods, 3 and 6 months later, the S&P was lower. So it's one indicator. Things look very good,
Gotcha.
But let's just be aware of things that could go wrong.
So, Bob, note of caution in your voice around what stocks have done recently, and you think the Fed is wrong in its assessment that the job market is weakening in any meaningful way. So how much risk is there, you think, to the stock market with inflation, perhaps reawakening based on policy and immigration or tariffs starting in 25?
Well, I think we're in a perfect sweet spot for stocks here, where we have pretty strong growth. We have very strong income growth from household sector. And the Fed, despite indications from the data that the job market remains very strong, is very committed to delivering interest rate cuts. And they're probably not going to get stopped until there's overwhelming evidence that inflation is elevated relative to their mandate, enough to change their minds. That's probably going to take 3, 6, 9 months before we get enough data where they would start to call into question. And so a perfect sweet spot for stocks where you've got a commitment to easing monetary policy at the same time that growth remains pretty good.
Okay, so Paul, we're going to have the holiday season results in by the time Bob thinks we get any indication on what inflation might be doing or not again. So with Black Friday at the end of this week, how much do you expect the overall market to react to fresh data on how the consumer feels about spending?
So I think the Black Friday numbers that come out this week are very, the market has started to not focus too much on those numbers. They tend to be maybe like a one-day event. But I think the overall numbers are going to come in good. We're starting to see confidence numbers pick up as far as the sentiment surveys are concerned. And so I think that's going to create some strength. Retail sales have been coming in better than expected. And I mean, just look at the retailers today. They've just been on fire. So you have the consumer discretionary sector up over 1%, even as like Tesla, one of its largest components, was down pretty sharply on the day. So that's some broad-based strength within the retailers.